Peter, I love talking to you. All right, I'm
Great.
not going around the bush, and so welcome back to Face, buddy.
Thank you very, very much. Yeah, thanks. Thanks. Yeah, I'm not sure about Blake's comment about cutting the
On
hair
your
and
hair.
looking younger. I think
Yeah.
I think if it's going to make me younger, I'm going to shave everything off.
There you go,
Yeah,
Peter.
yeah.
Now we're talking.
So you want to look like Ryan. Okay. Anyway, Brian doesn't shave the rest of it off, do you, Ryan?
Yeah, yeah.
Oh, you do?
It all
Okay.
goes.
Well,
It
you were
rotates.
fortunate when you were born because it became the style. You know what I mean? Uh, anyway, enough about hair. Let's talk about not letting hair grow on her account. And Peter, I want to start with this, and it'll lead to another discussion, but you have a Dow chart that shows a double top at 40,000. The Dow chart, it was kind of historical. I think you shot it to me over Skype.
Let's have a
And
look. Yeah, I think we've got a long-term Dow chart. Can you see my
yeah,
screen okay, by the way?
yeah, got it.
Yeah.
And
Okay.
and okay, so here's my
How about
question.
that one? Yeah.
That wasn't it, but it did show, well, maybe that was it. It showed a double top at 40,000. Okay, so that's not the chart that you
Not that one.
this is more it's what you shot to me on Skype. So I guess you didn't publish it, you just showed it to me. But the point was, when did you first come up with that 40,000 target? It was quite some time ago.
Yeah, I think so. Yeah, actually, it was because I mean, I think I remember now. Yes, it was because there was headline news a couple of weeks back, wasn't there?
Yeah, people were
That
putting their 40,000 cap on.
that's it. Yeah, I mean, they were talking about 40,000 because we just got there on an overnight close on the index. I think the futures had already been trading above, but everybody's looking at the cash, so I think that was it. And I sent it to you because I actually had to go back through our research to find out how long ago it was, and I think it was the back end of 2015, I think it was, and I think it was going back to sort of somewhere around here,
Okay.
around where I'm pointing to now, and
Yeah.
it became sort of obvious when we were looking through and doing comparisons and everything that 40,000 Dow was going to come in. I think I now know which long-term chart this was because I think it was probably something like this one. Yeah, the very long-term.
Okay.
This is going back to 19.
It showed the double top, but anyway, so you had 40,000, and your comment was amazing how time flies. That was, I don't know, 13 years ago you did that. So
Yeah.
that leads me to, before we talk about forecasts, another question that I'm sure you go through, I go through. Have you ever noticed that your original ideas are the best? And then, because we're close to the markets and watching the progression of things, that will sway away from our original idea, which turned out to be correct because we might be looking for one more high or one more low and trying to be perfect.
Mm-hmm.
That happen to you?
Yeah. Oh, absolutely, it does. Yeah. I mean, I think that we try to be adaptive, don't we? When we're sort of following a current existing forecast, and then the years or months tick by, and gradually you start to think, well, okay, that pattern suggests a little bit higher, or maybe we won't get that high, and we adjust and do things. And then later, you find yourself going back to the original, more intuitive forecast that you made some time ago, and that's often the case. Very much, I find that, yeah. And sometimes it's just best to leave alone. I mean, obviously, the thing that happens with Elliott Wave is that you're continually adapting to more information as the pattern builds,
Right.
and invariably, it's best to, if you're trading, of course, it's really best to just leave things alone, because one of the temptations with trading is that you either jump out of your original trade too early, and rather than just letting it run. And that comes down to doing more trading. I think when you're trading more, and being a bit more of a trader rather than the analyst, or combining the two, you tend to find that through the experiential point of the trading aspect, that you tend to rely on those original forecasts a lot more than perhaps you might have done without the trading element input.
Right.
Because
Exactly.
with the trading element, you're training yourself at the same time to hold a position through its to fruition, and that's an important aspect of any sort of trading, to be consistent with making profits. Because if you don't hold on to those winning trades when they come, you may end up either underperforming or actually end up net losing, because you've got to allow those big runs to occur when you get the right positioning on board in the first place. So it does encourage you in a way through that process to hold on to what you did originally.
Okay, so important. That's an issue with me. I bought the bottom in miners March 1st and didn't sit long enough. So that's a great idea to write down what your, a few different targets and what your long-term target would be on that, and at least keep something until that target is achieved, unless, you're stopped out in the meantime, instead of just taking it because it's overdone. And it was a good trade. You always think you could re-enter, and then you turn your head, and then all the windfall profits happen without you. Okay, so looking at this Dow chart, so it looks like you think that double top could be taken out in the Dow before it turns south over 40.
Yeah, I mean, well, these two tops here.
Yeah, that's 40.
Yeah, okay, yeah. Well, I'm thinking that actually in the very short term, probably not for the Dow. It seems to be underperforming. If you take a look at the shorter term positioning, this was published in our report from last Friday, but basically it shows that we've actually hit a top in April, early April, on the Dow already. So we've got a bit of relative underperformance in the Dow relative to to the S&P, and the S&P and the NASDAQ should make new highs.
Without the Dow.
Without the Dow, yeah. I think keep a lookout for that, because we're already seeing a top effectively in early April, and this movement down into the mid-April low was a 5-wave sequence. It could have been that it may have been that subminuet wave 4, which you see here on the daily chart here. We could have shifted that across to make this an expanding or running flat, and then you could make a higher high. But look at the way last week it sort of developed downwards into an impulse wave.
That was a 5.
We've almost gone back to the mid-April low, which again is another confirmation of underperformance. And I think it's going to be a struggle for the Dow then to make this high. But of course, it can do a deep second wave retracement again. You can come way up here, and that wouldn't be a problem. But what it does do probably is it sort of gives some sort of suggestion that the movements to higher highs in the S&P and NASDAQ are going to be modest higher highs. They're not going to be, huge higher highs, simply because of the Dow's underperformance. So, you've got to be very alert to this, and this is going to bring the next setup. But that's one of the things which I think is going to really sort of help us to time the exact top in the S&P, which looks a bit like this one, where we've got a target that's getting up towards the 55 and handle, somewhere up there.
Okay, maybe around the solstice, June 21st or early July.
Well, yeah, those are sort of a very big calendar dates for GAN, isn't it?
Yeah, the solstice.
GAN's analysis, yeah.
Or Trump sentencing on July 11th before the convention. So, a lot of people think all markets top and bottom together. And right now it looks like that, but there are some exceptions. And I believe you think Nikkei has already peaked.
The Japanese market, yeah. Well, that's a jump. Okay, yeah. Japan, yeah, it looks a bit stretched. Although in the report on Friday, I did mention it might take out these two residual highs. There's one here only because we've dropped down in 3 waves into last week's lows. You see here.
Yeah.
It might, if it takes out this secondary high, 39,999, then it's going to probably take out the high here and get up to some original numbers that we had at 41,884. But the bigger picture, you see, is a very big double zigzag from the pandemic low.
Yeah.
This is clearly a double zigzag, mainly because we can also see a triangle down here, which gives it away a little bit, because triangles don't occur in second waves, as you probably know from an Elliott practitioner yourself, and of course that sort of means that it's not a second wave, it's a B wave of a zigzag, and we've got an elongated C here, which is the C wave of the secondary zigzag. So we're getting into sort of the right numbers where this can collapse down. But of course, that's quite interesting, because since Warren Buffett announced that he was getting involved last year in a more significant way, a lot of fund managers have jumped on board. But generally speaking, I think the Nikkei is not too dissimilar to some of the correlations that we're looking at in dollar yen and also 10-year treasury yields. Because if you go to look at the correlation between, so look at 10-year treasury yields and dollar yen, one of the things that's very noticeable is that from last December's low, so when the 10-year yield was here, 378 moving up, this is actually a double zigzag pattern that ended in April. And for dollar yen, this was a single zigzag, but they pretty much timed together. So we're looking at a composite sort of comparable decline for both now. And that should also pull the Nikkei eventually down, but it might just be delayed a little bit. You mentioned dual, comparable highs, simultaneous highs, but that wasn't the case when you go back to look at the indices in 2021-22. So, for example, the S&P topped out in January 22 here, but the NASDAQ was obviously November 21.
Earlier.
Slightly earlier here. And if you look through several indices, you'll find that, it's split about 50-50. Half of the major indices topped out in November 21, and the other half topped out in January 22. And of course, this also goes through to the relative performance, which is something which, I've talked about a lot in the last 12 months, because we've got some indices which are breaking above the old November 21, January 22 highs, like the S&P and NASDAQ here. So we're broken slightly above. But for a lot of other major indices, we haven't. And it really comes down to sort of breadth and looking at things like the Russell. This is the Russell 2000 small cap. And you can see we're still a long way from breaking the old November 21 high here. Up here. And if you go through to look at some of the others, like the mid-cap indices and some of the sectors, we look at some sectors here, you'll see that the top is consumer staples sector, XLP. So we're still below the old highs here. This one is April 22. So there's no... That's one of the exceptions to the rule, really. This one is November 21. This one is XLY, which is consumer discretionary. And this one is Prolog. This is the real estate investment trust, PLD, logistic. That one was April 22 as well. That was well down. Well, you know what's going on in the commercial real estate sector. It's broken, like, basically.
Analogous to ghost cities in China.
Right, absolutely, yeah. This one is pretty much broken. So yeah, a lot of these indices are well below the highs. And if you also take a look at something which I update fairly regularly in our reports at the moment, is something that not everybody's so familiar with, and that's the NASDAQ Next Generation Index. This one is it's the top 100 shares below the NASDAQ 100. So it's technology indices and stuff like that, but below the NASDAQ 100 listing. It's the sort of second division tier. which is a bit like looking at a mid cap or a small cap. And here we are, you know, well below the old November 21 highs. So you see, this is very interesting now, because if you've got a lot of indices which have broken the highs, but in three-wave patterns, and you've got some which are still below those previous highs of November 21, Jan 22, these are only because you've got two different corrective patterns. Now, a lot of them are zigzags like this, zigzag A, B, C. So this corrective rally is a zigzag. If you take a look at something like the value line, which has a much broader perspective, you know,
or equal weighted S&P,
or maybe an equal weighted, which I actually have got somewhere. But this is the value line. You've got a zigzag still, okay? It's all coming from the October 22 lows. A, expanding flat, really nice expanding flat for B, 5 ways down subdivision in the C wave there, and then you get the 5-wave pattern up for wave C. So this one actually breaks a high. Okay, so this zigzag is an outperformer. It's broken the previous high, but it's only a nudge. It's only a Fibonacci 14.6% increase above wave A. So it's not really much. But this qualifies as a zigzag here. This pattern qualifies as 100% equality in waves A and C. And it proves to be the wave B of a larger expanding flat. The larger expanding flat is basically this one here. So we've had a zigzag rally in the value line, the Dow Jones Industrial Average, and so many other different things.
Isn't the S&P, I've seen some Elliottians label this as an expanding flat, this rally from several hundred handles lower, and are still looking at it as an expanding flat. Is, in your eye,
yeah,
an expanding flat?
Yeah, I think that the lows in 2022, you've either got lows in June 22 or October 22. Again, you haven't got exact timing correlation. For example, the Russell 2000 bottomed in June 22 and then did an expanding flat for the Russell. Well, let's have a look at that to start with. So we'll go back to that one, have a quick look. Here it is. So here's the 2022 decline. Here is June 22, and this is the expanding flat. A, B makes a slightly lower low, and then you have 5 ways up for C, makes a slightly higher high. So we qualify that as an expanding flat. Well, that expanding flat is duplicated in the S&P and the NASDAQ, except that you've got much bigger amplitude because they've outperformed. Right. So wave A comes up a bit higher, you get an elaborate B, and then C goes up. So here we are looking at, let's go to the NASDAQ for that one. So we have 3 waves down for wave A, and then the expanding flat is like this, A, B, and this enormous C wave. Now that C wave, that 5-wave pattern, it actually is an Elliott 9-wave sequence, 1, 2, 3, 4, 5, 6, 7, 8, 9, has a subdivision of 5 waves in the 3rd wave. Now, the interesting thing about this is that 5-wave advance for some big equity markets, like if you go to, I think, well, certainly NVIDIA is a good example.
Yeah.
But I think you could probably look at Apple or Amazon. They all bottomed in their 4th waves in October 22. And that 5-wave pattern in those big Mag 7 equities, that's all the 1st wave of a bigger 5th.
Okay.
You know, that's
all right.
That's where we get the pattern correlation working exactly. So some of these big Mag 7 equities are moving up from the same date of October 22, but their 5-wave patterns are coming to completion right now and are ready to roll over to the downside in the months ahead as perhaps a 2nd wave correction. But this one is going to be a C wave decline here for an expanding flat. So A down, expanding flat for B and C. And that's where we come to sort of this idea of the expanding flat, but the B wave, rather than a generic zigzag like in the Dow, you've got this expanding flat here, this one.
Yeah, or an irregular.
It's an irregular, yeah. In the old days, we used to call them irregular flats, didn't we?
Okay.
Yeah.
All right, well, eat prunes, flat. So Peter, anyway, Peter, we have this scenario where like TLT and the bonds really held an important area and turned up, really kind of like a graveyard save at important support. Like TLT went to 61.8 and a wedge line, and the 10-year retraced 78.6 and started heading lower. So you're looking for lower yields. Could this be both, at least in initial stages, lower yields and a lower dollar jet fuel for this final stage melt up?
Yeah, I think I mean, one of the things that was troubling me earlier this year was that we knew at some stage that Treasury yields were not giving a complicit sort of major decline. And of course all of the surveys that we saw in December last year showed that all the surveys were showing that I think something like 60, no, it was even up into the 80% area, were expecting 150 basis point cuts by the Treasury this year, by the Federal Reserve rather, and that was an historic peak of optimism. And whenever we'd seen that before, it was like 2 standard deviations over the previous ones, which the last one, of course, was the financial crisis period, where people expected major cuts in interest rates. And in fact, the 10-year Treasury yield did 100 basis points to the upside. Well, this one, as you can see, went up from 378 to 473, almost 100 basis points as well.
Right.
But it did so in a double zigzag, a price swing sequence, and it topped out in April, timed it out with the exact top that we saw in dollar yen, when Bank of Japan were rumored to have stepped in for the first time. And then, of course, since then, we've seen 5 waves down, a nice 5-wave drop. You can see that here in my worksheets, actually. Nice 5-wave development down since then, and a nice 3-wave push up last week. And you can see now the yield is trying to hurriedly sort of pull down, because it's starting this drop down to 358. Well, I have to admit that I've been watching the bund yields here in Europe as well now, and this extra push up last week actually caused a break above the April high in the bund yields.
Interesting.
And that meant it was, in relative speak, sort of underperforming, and that more or less, let me find it here. I think that more or less confirmed. Here it is. Here's the April high in the bund yields, and we took that out slightly. It created a slightly different pattern, whereas before it was only 3 waves up from 222 to the April high. It's created an extra sequence, created 5 waves up as a diagonal. And if that's a diagonal, then we're moving up into a zigzag from December's low, from the same low that Treasury yield started their 100 basis point push up. And this is now turning downwards. And that means that in all probability, this can trade down to sort of something like 120 over the next several months into year end, early next year. That's a huge move.
Boy, does that fly in the face ECB meeting this week. Everyone looking for a hike. Almost makes me think that
they're looking for a drop, actually. Yeah.
A cut.
25 basis
right,
point
cut.
That's
right.
Yeah.
So it almost looks like the market has it starting to price that in.
So the big question then is 358 enough, or is that not enough? You know, is that? I still think that with the zigzag upswing for dollar yen, that dollar yen is also involved in a diagonal like this, and if that's the correct, here's the zigzag upswing for dollar yen. If that's correct, then this will drop quite severely down to 144 3/4 before it goes up again, which does dovetail in with this idea of the diagonal still. But I'm not certain about that. The only thing I can tell you is that all of the clients that we're speaking to, institutional clients, that is, all the banks, tier 1, tier 2s, also some of the fund management in pension funds, we're telling them of this decline coming, and they are now positioned for this decline. And if it's so,
they buying duration? Are they buying duration?
Well,
Like going out?
they're buying a little bit of duration, but actually they prefer to buy the short end, actually.
Okay.
But
because it's only a trade, it's because higher yields to come after this decline in yields. So let me ask you this. I see 358. I know the calendar isn't exact, but it looks like that's going to happen in July.
Well, I think we could probably push this out to sort of October time, but I don't know. I don't know the timing of this. It could be very quick. I'm not sure. I tell you what I am watching, and anybody watching today and listening in, I'm just watching how I think we've got some JOLTS numbers this week, haven't we? Sometime, is it tomorrow?
I'm not sure. I know we have NFP.
I think the JOLTS. I think the job openings comes through tomorrow. And we've got a sort of an ADP report as well coming up before Friday's non-farm. But keep a lookout also just for the weekly employment report. I've got a funny feeling that if we're going to see a downturn in equities soon, and we're talking about a final push up for the S&P and NASDAQ first, but before that turns around and heads down, I would think that pretty soon, sooner or later, we're going to see that weekly jobs numbers. They're going to start moving up quite strongly. Now they've been around 182.20. But I think that keep a lookout for a sudden jump where it goes up to 280 to 300. Keep a lookout for that, because I think that will be the first indication of where the market suddenly melts to the downside.
Okay.
Yeah.
All right. So bad news is good news is bad news for the market.
Depends what your positioning is.
Because otherwise, if we made the highs in yields for 2 in the 10-year, and we get a jobs number like that, I don't know about 358 before 463. So you're saying that the market still thinks good news is bad news, but at times good news has been good news too. So anyway,
well, that's certainly been the case in stocks, isn't it? I mean, everything you throw at the stock market, that could be negative has been brushed aside, which is a bit of a hedonistic sort of indicator itself. I mean, unfortunately, we don't actually have a Geiger counter that could be converted into sentiment that sensitive enough to tell us exactly when the top's coming. But it's close,
Okay, so do you cover the peso?
Mexican peso, yeah.
All right, so we had an election here, and it was basing out. I'm wondering what your long-term count is on this, if this is just a bounce in a bear market, USD MEX, or we've staged, we put in an important bottom.
Let's have a quick look. Got a lot of currencies, and I'm off the. Whoops, sorry. Let me just try and see if I can find it.
Do you like wheat now? I see you're following commodities. Does the wheat look good to you?
I haven't really followed wheat really intricately, to be honest.
All right, there's the peso.
Well, this is the peso. I mean, the thing is that look at the date where it topped out. Look at the date. This is April 20. This is the pandemic high, right?
Right.
And it's been trending down since. So it's been a huge outperforming currency.
Yeah.
Really huge outperforming.
So this election bounce doesn't mean much to you. There's still much.
Well, this is a weekly chart. I mean, it's basically telling us that the bigger picture is very much to the downside. The dollars, when you look at the Mexican peso, this is very long term. This is the short term picture on the daily.
Okay.
It might be that we've actually got an expanding flat there, but overall the trend is down. But the dollar is weaker against pretty much every global currency. I think the only thing that it's not been really massively weaker against is the Indian rupee, but even that's about to turn around, I think, and strengthen. And we've got a basic proprietary Asian dollar index. JP Morgan used to update one, but they stopped it. We've created a model ourselves since that sort of stopped, and the Asian dollar index looks a bit like this on a longer term perspective. It's just building up because it's doing a calculation model with about 10 Asian currencies, and so
by
it's just,
Asia.
basically, yeah. I mean, but this is again another example of US dollar weakness coming. You know, it's nothing to do with Asian currency strength per se, or even G10 dollar pair currency strength. We're not talking about individual currency strength here. It's basically dollar weakness, and I'm really amazed to see it. But you know, there's a lot of investors out there still dollar long.
Yeah, it's a crowded trade on the long side, isn't it?
That's certainly the case with the commitment of traders reports. Yeah, if you look at those, and I mean, it's not an extreme dollar positioning historically, but it's still relatively pretty high. It certainly makes, if you look at sort of Bank of America's latest surveys, the dollar is in the top 10 of all asset classes, you know, or individual contracts. It's in the top 10. Obviously, the big one is basically tech. You know, that's 60 odd percent or something. Yeah, the most crowded trade. Ironically, you know, in the top 10 is short China. Fund managers are very short China. But dollar is very long in that top 10. I think it's in the top 5 anyway. But you see, the problem you've got with the dollar is that this is a major high going back to sort of October 22. You've had 5 waves down, a really tight second wave
2 years
correction.
of sideways, almost 2 years. Kind of
Well,
like the Canadian dollar. The USD CAD has a 1.5-year distribution pattern to me. You know, hasn't gone anywhere for a year and a half.
Yeah, I mean, this is the Canadian dollar, and you can see, yeah, it's bumped along. It's just gone nowhere. But all of these currencies are getting ready for something special to the downside, really something special. And it's about dollar weakness, really, US dollar weakness. It's nothing to do with anything else about currency strength. So the question is, what's going to basically collapse? What is really going to collapse the dollar down? You know, what is that going to do?
The political system, the election, confidence crisis, constitutional crisis. Could it come from politics rather than financials?
Well, it could. I mean, we are in an election year, but it's not until November. It's a long time to wait. Stock market should turn down before then.
Well, I'm talking about the dollar, lack of confidence in the dollar. And you're looking for down, which is going to have a lot of people off sides. Then I want you to go to your website, because people are used to the dollar rallying if we get a decline in stock. You get some safe haven buying. You're putting out the narrative that the dollar will weaken as the dollar weakens. Can you explain that to people? Capital flows?
Well, I think that there's a big discussion about capital flows because we've seen that central banks around the world have been steadily declining their dollar holdings over the last decade. And that's starting to accelerate a little bit because don't forget that we've got a big problem with NATO versus Russia at the moment. And the BRIC countries are fast increasing their memberships. And as part of that membership, they're encouraging to de-dollarization going on. And at some stage, there must be a trigger point to that. And it's difficult to know exactly the timing of something like that because it's a very big macro discussion. But and we don't know. But if things come to a point, I mean, Russia is getting very, very aggressive because of NATO's intrusion into Ukraine and the latest funding proposals that have been ticked off. And the Russians are basically saying, hey, you guys, you know, NATO said and gave promises over 10 years ago that it wouldn't start putting armaments into Ukraine and start infringing the old Soviet borderlines. And NATO has basically infringed upon that. Now, if Russia starts to increase its incursions and NATO starts pushing back, we've got a big problem. You know, we've got a big problem. Now, normally, that would be safe haven dollar, but we're just not seeing it graphically represented. The only thing is that we've been taking a look at the other two currencies, which are safe havens, which is basically Swiss franc and the yen, don't forget. Well, what's happened to the yen recently? Well, it's, you know, could the yen start staging a big recovery revival? I think it probably could. but we've actually got a Swiss franc yen chart here, just to take a look. And let's have a look at it here. Swiss franc yen. This one is getting very top heavy. Very top heavy. I'm not sure that that's going to necessarily mean that Swiss franc is going to push up a lot further anymore here. Yeah. That dollar yen, that sort of Swiss franc yen chart is going to start turning down pretty soon. Okay. Very, very top heavy indeed. So that brings an interesting discussion. It's worth following those. What are going to be the main outperforming currencies going forward? And I think if you take a look at something like euro yen on the crosses, I think we've got every reason to think that that has topped out already. And if I can find it, euro yen, and that's going to start turning down here. Okay. That's very, very top heavy. So there's an interesting discussion about that. But really, yes, I do understand the logic behind US dollar being a safe haven in all of that. But
it's not happening this time.
No, it's not going to happen. It's not going to happen. I mean, if it was, we would be getting alerts saying on some of the crosses, or at least some of the G10 pairs, that it wouldn't happen. But it's consistent right the way through every single currency that we look at. Yeah. All
right. Well, Peter, a lot of people are asking questions on different markets, but we've already gone 7 overtimes. So
sorry about that.
So no, I'm not sorry. I want to thank you for edifying everybody today, and some very interesting looking charts we've covered here today. So if people want to know your view on some of these markets they've requested, how do they get it?
Well, thanks. Yeah. If you're curious, pop in and have a look at us. Do so. We've got a few reports which you can subscribe to. I think one of the popular retail reports that we have is the Elliott Wave Compass report. So if you go into, this is wavetrack.com. This is our homepage up here. Sorry about that. And then we've got subscription and the Elliott Wave Compass report. So it's $39 a month. We publish 2 reports a week. And if you do subscribe and go through the registration, let me just show it to you. So show you what it looks like. The Elliott Wave Compass report, you log in and look like this. You go to the report. And these are all the updates. If you click on the first one, for example, you can just actually then scroll through.
Yeah. And you also have some text describing the different sectors.
Yeah, so there is. And the report itself, well, anyway, that's one way to look at it. There are some other reports. If you're interested in looking at stock indices, you can go through look at all of these major indices on a longer term basis. And actually, we're working on, currently at the moment, our mid-year reports. And the first one of those is Stock Indices. And when we publish this in the new year, we normally publish these on our blog, which is on the first page. You can go into our blog, and we publish exactly these.
Oh, there's a chart. I go underneath the picture of those guys.
Ah, there we are. Yeah. Here we go. Yeah, outlook for forecast. That was the old 2016 forecast.
So you called 40,000 Dow in 2016.
That's right. I think it was.
Okay, not bad.
I think it was 17,000 at the time. Yeah.
Yeah, nice call, Nostra. Good.
Yeah, thanks. And so yeah, we're going to be able to publish those when they're coming up for release pretty soon. This was the that's some of the supplemental stuff. But anyway, we're going to be publishing those, and that's going to show you exactly where we are and what the upcoming declines look like for the major stock indices. And later next month, we'll be publishing commodities and then going on to part 3, which is currencies and interest rates. So stay tuned for those, because there's a lot of information coming through. And we'd be happy, certainly, if you could start subscribing to Elliott Wave Compass. You're already going to see a lot of information in there. And here's the descriptive text, and you can actually download the report here. And well, that's not working at the moment for some reason. I'll check that out later. But otherwise, yeah, okay. Please do. It's a great and very popular sort of subscription.
Okay. Peter Goodburn, everybody. Go
Thanks
to
very much.
Yeah, go to WaveTrack, Elliott Wave _ WTI. That's his X handle, and Peter doesn't tweet a lot, so what's that subscription? 39 bucks a month. Peter.
Thanks, everybody. Thanks, Dale. It's been great to talk to you, as always.
All right. My trading warrior brother, Peter Goodburn. You could join the team in 4 minutes on the morning edge. And don't just count your waves, count your blessings. Thank you, everyone. Thanks again, Peter.
Well done. Thanks, thanks too. Goodbye, everybody.
Bye-bye.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.